All right, then let's get going and we'll start. So our mission here at KWB is that we believe that with great advice and simplified accounting, business owners are going to be able to make better decisions, and by doing that, they're going to be able to run their businesses better, perhaps spend less time in their businesses, focus on what's important to them, whether it be parts of their business, their personal lives, their families, things like that. And so, for many, many years, we have, seen, realized, understand that it's tough for business owners to make decisions because often you're trying to do that without the information you need. So you're making decisions on the fly, right? You're making decisions based on your gut. You maybe have information, but you don't trust it. You're going off of bank statements sometimes and not actual financial statements. You're doing things like that. So, you're not managing cash flow on a day-to-day basis. You're only looking at your information once a year sometimes, and, sort of a worst case scenario when it is done by your accountants at year end. So this presentation is going to talk a little bit about the type of information, how to improve that information, where to go with that, and how that looks so that you can then see, wow, having good information will help me make better business decisions. Okay. So, let's start trying to be proactive instead of reactive when we're looking at that kind of thing. So we have a division of our accounting firm called On-Site Advisory, where we like to help our clients focus on move from what happened in the past to what's happening today and what's going to happen in the future. So we try to show them how to operate their business in a much more proactive way through goal setting, planning, and measuring that progress. It's a powerful way to elevate your business decisions from the sort of the day-to-day to more strategic. Where am I going? Where do I want to go? Right? It starts allowing you to think about it from that perspective. It'll also help you to know if you're on the right path to where you want to be, so that you can identify that and correct it if you need to. Next slide. So today we're going to talk about what healthy financial books and records look like and why that's important. Some tools to help make maintaining those books and records a bit easier. Best practices for your data management. Reporting for the decision making, because there are lots of different report opportunities available depending on where your information is and how it's held and that kind of thing. So it's not just the simple profit and loss or income statement. There are other things that can be done. And interestingly, those things will allow you to look at your information from a different perspective, right? It's kind of like looking, I know sometimes, you go on a trip and you're saying, okay, I need to come back to this spot, and you're looking forward and you walk forward that way. Well, when you walk back the other way, you can't even tell where you came from because it looks totally different when you come back at the other way. So those kinds of, insights into how your information looks will help you, understand your financial results better as well. And then we're going to, if there's questions and answers at the end, we'll be able to do that. And, like I said before, if there's anything specific for your business that you can think of or that comes to mind as we're going through this, then by all means, just jump in and let me know. All right, so the financial information and books and records is the foundation for your day-to-day business. Lots of people put off, bookkeeping and doing the work to keep it up to date because it's time consuming, daunting. They haven't been trained to do it. It's just downright painful. If that's the case, then every quarter or every year end, when it's time to finally get to it, it can be a mountain of work. And, but if you don't do that, it can leave you guessing throughout the year, right? And without accurate books and records, you end up being, I like to tell people, it's a bit like trying to drive at midnight with no streetlights and no headlights. right? Like you're moving and you can't stop yourself and you got to keep going, but you can't see what's happening. Is there a curve in the road? Is there a car coming? Am I going to be off the road? Like what's going on, right? So the financial information provides the light to allow you to know, kind of where you're going, right? Healthy books and records are accurate, up to date, and reliable. They should be there when you need them, right? The sometimes the difficulty is you need to make a decision. You want to, oh, well, gee, okay, well, where was our cash at the end of May? And it's like, oh, well, we haven't updated our books since the end of March. It's like, oh, geez, well, is that going to be good enough? Is that going to be accurate enough? It's like, oh, I sure wish I had, my records to the end of May or even to yesterday, right? And if you're on QBO or even another cloud-based, I know, Janice, we've been having some discussions with you about migrating, to QBO and that sort of thing. But, even an online program, and even if you don't have an online program, your desktop, but you'll see that there's big advantages to the online programs as well, right? Um, and just like, another story I like to sort of lean on is that just like if you run a business, and Gavin, I don't think you have a lot of assets in your business, but Janice, I know you do have some assets in your business, equipment and things like that. Just like you don't wait for that to break down, right? You maintain it regularly. You want to maintain your books and records regularly as well, right? And keep them up to date because you wouldn't just again wait for that equipment to break down before looking at it. You would look at it every quarter or every 6 months or whatever the regular maintenance schedule for that is, right? Your books and records should be up to date and maintained on like at least a monthly basis, if not weekly or daily. So, and then moving on. um So QuickBooks Online is our favorite cloud-based accounting platform. We've been using it now for 7 or 8 years. Personally, like within our firm, we use it, and we've been using it for that long. We've been recommending it to clients for that long. We have a number of people in the firm that are considered QBO experts and are actually certified, like Pro Advisor certified as well. And we really, really like it. It connects to like 450 different apps, and that grows, every month. There's more and more, all sorts of aspects of your admin side of your business, but also tons of aspects to the operational side of the business, right? It can do timekeeping, it can do job costing, it can do field work management, right? Like I'm out doing this job this morning. Where do I need to be this afternoon? And where do I need to be after that job is finished? And it allows you to, book those jobs in such a way that it's, in the same general area and other things like that. So lots of really great tools that help to automate your whole system, both admin wise and operationally. Moving your books into the cloud also has many benefits, but some of those benefits are it allows you the ability to work from anywhere, especially if on the go. Again, whether it's on the accounting work that you're doing or whether it's on the operational side and you want to check where your team is, right? You can be on the go and you can log into, your job management program and find out, what jobs your team are at that moment, right? QBO in terms of accuracy improves accuracy because it connects to your bank and pulls in your transactions automatically, right? It also helps with, again, another way in that it helps with accuracy, but also helps to reduce time is that you can set up bank rules within the program. So, and tell it that anytime that there is a charge from the TD Bank that's more than, $1, but less than $20, just put that to bank charges, right? Because it's not going to be like a more significant transaction or whatever. So you can set up general rules like that. Anytime there is a charge for a local restaurant that you go to that's between $10 and $50, put it to meals and entertainment, You know, things like that. Anytime that if you've got a monthly rent amount, you know, anytime there is a rent amount of $1,650 exactly, put that to rent. And then if you happen to pay something different than that, it'll throw it in the, you know, category to still be reviewed. So it really helps with sort of that basic bookkeeping level, and then and data entry, and then it's up to us or you to do like the data management side of things. Security is also built into the program, so it's very secure. You know, they spend millions of dollars every year with ensuring that they're all of their programs, their where the data farms, where things are kept, are super secure. So, you know, and even if there was a hack, which there never has been, but even if there was, none of your banking information or anything like that is stored in QBO. It's all done on setup, and that's one of the only sort of somewhat frustrating or aggravating things is every once in a while, every month or two, you might lose connection to your bank and with QBO because the bank does an upgrade or something like that. And when they do, they'll reset the login, and you just have to, you know, reconnect it so that it's there. But, you know, it's a small price to pay for the security and comfort that you get. All right, moving on to one of the key apps that we use with QBO. There's two or three that we really like. Dext is a document management system and document retention app. WagePoint helps with payroll. We like it a little bit better than the QBO payroll system embedded or app embedded with QBO itself. And then there's a program called Pluto that allows you to make payments and receive payments. And we find that one very helpful as well. But Dext is probably the best bang for your buck in terms of what's one of the first apps you should use and get money time back. And so it connects to QBO. It digitally manages your receipts, bills, invoices, and other documents. So you can even upload lease agreements and things like that if you want to. So it's sort of like a secure cloud-based filing cabinet. But the main ongoing way to use it is that you snap pictures of receipts on the go. You have them filed automatically and synced to your QBO. If they're larger than like a one-page receipt or something like that, or it was emailed to you, you can also email or scan. If you email it, you have a special email that you can send to, and it automatically uploads as well. Or you can scan it and then send it to that same email. And that works for really good for larger documents or, you know, lengthier emails that you receive that have multiple pages to them. So here's an example of how easy and how quickly Dext can work. Can you guys see that okay? Yeah. So in the bottom left-hand corner, you'll see there's a number there, basically a .pdf that's in blue. So that is the actual document that was uploaded through Dext. And this is a QBO if you guys aren't familiar, this is a QBO screen that we're looking at. Okay, so this was in QBO. We clicked on the actual, we probably went to a GL code. So in this case, the Home Depot credit card payable. It's the credit card payable, but so it's this was probably like a expense category, maybe like supplies, you know, shop supplies or something like that. So, you know, we clicked on that shop supplies. We then saw, oh, what's this expense for $458.06 from Home Depot? We double clicked on that, and we got taken to this screen. Now on this screen, I can double click on that blue, you know, in blue document number below that says .pdf, and this is what's going to come up. The actual receipt, next screen, Samantha. The actual receipt from Home Depot that we took a picture of and that we uploaded to Dext. So we uploaded it in Dext. Dext matched it to QBO, and said, oh, this, because it has OCR, optical character recognition. It scanned this whole receipt. It read that it's from Home Depot. It read how much it was. It even identified the GST. It said the full amount of 458.06. It then matched it to the Home Depot credit card transaction line that would have been on our credit card statement that's in QBO, and attached it to that line. And then we just needed to verify that that was accurate, just in case, in this case, it would have been easy to verify. Some cases, if it's the same repetitive amount or something like that, there could be a timing difference or something that you need to sort out. So we can go double click on it, and boom, it tells us exactly what this receipt is. And back indexed, if there was any kind of a thing we wanted to change, right? So instead of having it in the category purchases, we wanted to change it to something else, office supplies, right? We could certainly do that. And if there was no GST, we could change the tax amount to 0 or something along those lines. So lots of flexibility, but now you've got the backup so that if the owner, let's say this is the bookkeeper or somebody else doing this, now if the owner wants to look up expenses, it's super easy to do that, right? Janice, you could be, in Hawaii and reviewing your financial statements and going, oh, geez, I wonder why that's up so much this month, and dig into that on QBO, even from your phone or whatever. Double click and pull up these kinds of receipts. I can almost do a semi-review from anywhere that your phone or computer can access, right? So it's there, the opportunity to review everything, and even accept it or push it forward if you need to within Dex. So a very powerful program that links with your QBO. The other nice thing, the other huge advantage of that is that if you're audited or reviewed by CRA or anybody else, all of this is stored electronically right within QBO and Dext. Actually, it's in both places. And then you just pull up the receipts and produce them and attach them and send them in, and they're fully accepted by CRA as fine. So, yeah, Janice, go ahead.
Yeah, I just wanted to, I don't know if you've had an opportunity to speak with Shelley, but we're working together this week, I think, sometime near the end of the week, and we are moving towards QuickBooks.
Yep.
So it's going to be a bit of a merge and a bit of a turnover, but yeah, that's good information here.
Yeah, no, for sure. Yeah, she had mentioned that you guys were looking at really seriously at that. So it sounds like that decision's been made. So that's good. Yeah.
Yeah.
Again.
So and also just a question when you're this is more of a detailed question. So we have the opportunity to go and change that Home Depot to a category that we think it fits into.
Correct.
Yeah.
Yep. Yeah,
Okay.
like when you first scan it, or when you first take the picture and put it to Dext will kind of see, either it knows from other activity with other clients or things like that, or it just knows who Home Depot is. And so it may pick a category, or you've bought something from Home Depot before and it knows that you put it to purchases before. So it will maybe put a default in for that, but you can change that before it gets what we call published to QBO. Right. So it allows you
And
that
once
filtering
it's
option.
published, you can't adjust it, or
Nope. If you want to go back, Samantha, go back one screen, right? So back to the QBO screen. Once it's in here, you can still click under category, and you could, where it says purchases, if you click there, you could change that to any other GL code you wanted to.
okay, very good. Yeah.
So there's still opportunity to change it even once it's posted. This is just where it's going to go when you post it for the first time.
All right, thanks.
Yeah. All right, so skipping past the receipt to the next slide then. So once your cloud accounting tools are set up properly and your bookkeeping is fairly automated and up to date, then you can start relying on your financial information. The difficulty about relying on your financial information before that is the old saying, garbage in, garbage out. If you have, information that you feel is garbagey and, not very good, well, then your decisions might not be very good, right? You might be making decisions on erroneous information. But once you know that it's tight, once you know that you've got the expenses in the categories you like, your bank and everything is up to date and reconciled, now you can have some confidence that the information that you've got is really, really good, right? To get there, like the last sort of step to get there and give you that comfort level is, you should be doing monthly reconciliation of banks, credit cards, things like that. You should be reviewing any of the outstanding information or outstanding transactions on those reconciliations. I have had had clients where there's maybe an inexperienced bookkeeper doing bank recs, and they're like, yeah, bank is reconciled fine, it's no problem, and there's like a 9-month old transfer on there or outstanding check or something. It's like, okay, well, though that's great, you identified them, but they also need to be resolved because, it's something like that should go away, should resolve itself within a month or two. And if it doesn't, then you've actually got an adjustment that you probably need to make. Right. So reviewing those, regularly review of your different reports. So besides the bank and credit cards, what's your monthly profit and loss and balance sheet reports looks like? Is there any really wonky things that catch your eye? What about receivables? What about payables? Do you have like negative numbers on your accounts? Do you have a receivable listing that shows a 150-day receivable, or a payable listing that maybe you try to pay everything within a 30 to 45 days, and you got something on your payables report that's like 120 days. Okay, well, you maybe probably paid it. Maybe it was double entered, right? If that's the case and you dig into it, then you've got to remove the second entry, or else you've overstated your expenses and understated your cash flow. Right. So those kinds of things should be done on a monthly basis, and that allows you to make sure and ensure that your financial information is good and ready to go so that you can focus on your cash flow. All right. So with all that in place, now you're able to use the financial information to make better decisions. Reviewing this regularly, we recommend monthly, but some businesses maybe quarterly is enough, but generally it's going to be monthly, and sometimes even more frequently than that. And if you aren't sure, just as a general comment, if you aren't sure how to read or understand your general reports, we're more than happy to work with you, teach you, help you understand those better, so that you can get just a better confidence and understanding that you're doing that. Reviewing your reports routinely is going to help you to spot trends and anomalies and even errors in your data, so that it's the first step and being proactively prepared to make those day-to-day decisions. So just as a quick example, and this might be reasonably basic, but this is a profit and loss report, right? And this is a small cafe that like a coffee shop kind of thing. And you can see that telephone and internet expenses, right? So the third item, under the rent area, has gone up significantly, 225% from the previous month. So, that stands out. Reviewing both the dollar change and the percentage change is a great way to double check what's happening in your business. And QBO allows you to set up your reports this way, right? And if you're not sure how to do that, again, we can also help you set up some basic reports, show you how to do that so that you can set up further, on your own. So you'd want to double check and go, okay, well, what's in telephone and internet? Maybe you've got employees that have telephones, and maybe, one of them did something, incurred some charges. Maybe there's an error from the supplier. Maybe there's something else. Whatever it is, anything that stands out is definitely worth, looking into. Not only is it a large, like when I'm going through, I look for the large percentage changes, but I also look for the large dollar changes. Right? The line item right above, lighting and power, is up 73%. That's huge, but it's only up $112. So I'm not really that worried about it, right? It could have been like one month is a lot colder than the other month. So, that's not that big a deal. I can certainly live with that. I don't need to spend any time, doing it. A couple lines above that, print advertising's up 446%, but it's only $120. Right? So I wouldn't worry about it. The main one is the telephone and internet, and then the rent. And then if you look at the very last line, the rent itself is up 116%, right? It's more than double. $4,200 the month before, $9,200 in the current month. It'd be like, okay, well, what's going on there? Hopefully you didn't double pay, but maybe you recorded it twice. Maybe you recorded a payment on the first of the month and the last of the month. And one of those should be the month before or the month after, right? Not a big deal, hopefully. Like, hopefully you didn't pay twice. But again, you want your financial information to be accurate in order for you to be able to make a better decision, because we're going to see that we pull up like cash flow reports that show us our monthly income on our monthly cash flow and things like that. So, again, having good information makes it a much better process. This was interesting because then we pulled this from a live client data and used it. And what was interesting about this one is, so we graphed revenues and expenses, right? So expenses is the bottom line, revenue is the top line, right? And you can kind of see, the revenues climb and then a steep drop. Revenues climb and then a steep drop. Revenues climb and then a steep drop. And this is over a 3-year period, right? So interestingly, for this client, every sort of July or so, June, July, there is a big dip in their revenue, right? Maybe they were aware of that, maybe they weren't, right? How closely were they looking at their numbers, right? It's definitely very seasonal, hard to know, type of business. Maybe it's geographically where they are, that makes a difference. Maybe it's the neighborhood they're in does something, who knows what it is. But we certainly can see that happens. So now we can go back to them and say something like, you know what? Maybe those are the times that you need to do some sort of special promotion. Maybe you're busy enough at the other months that you feel that that's fine. It matches your staffing reasonably well, that kind of a thing. But in these June, July months, you're understaffed, right? Or sorry, you're overstaffed. You don't have enough revenue. Why don't you consider some other projects, right? So it's helping them make some strategic decisions by looking at the financial information. The other interesting thing is when you look at the expenses, they have, a big jump every roughly 3 months or so. What it turns out this is that every 3 to 4 months is when they have a big purchase of supplies, right? They buy their paper supplies, they buy their coffee, they do whatever it is that they do. They tend to buy, and then they, go for 3, 4 months with what they've bought, and then they buy again. Right? So now it's like, okay, great. Now we can understand your cash flow better, right? When you've got a buy like that happens in June, July, you might end up having an overdraft. You might need some help with that, right? So now we're able to help them strategically and operationally run their business a little bit better. Once you start to gain more insight into the regular cycles and trends in your business, you're in a great position to start building an annual budget, right? So a budget is a great tool to help you start making some further decisions, right? This is an effective way to enhance your financial reporting. Probably you guys know that a budget is a financial picture that typically covers 12 months. It's used to determine what you can expect over the course of those 12 months, starting with your regular activities and then adding in new initiatives that you're planning, right? So, we often start with last year's historical information and then work with you to, come up with your knowledge, your strategic decisions of upcoming events to plan for. And then that sets the budget. So then if you look at the next slide, you'll see that, okay, if you review your actuals to budget on a monthly basis, and I don't know if you're able to, make that a little bit bigger, Samantha? Yeah, no problem if you're not. Um, yeah, that's good. So that gives you a benchmark against which to compare. So previously, we were comparing 1 month to the next month, right? And that gives us something good to look at, to see if there's an issue or anything we need to look at operationally. Comparing your actuals to your budgets gives you another thing to look at. Again, that perspective of, what are we looking at and from what direction? That allows you to then go, okay, well, I was expecting to have, a certain amount in this line item, but that's not what I had, right? So in this example, and this is an advertising agency, their consulting fees are much higher. And so consulting fees are second line under where it says cost of sales, right? So consulting fees were 84,000 compared to 12,000 budget, right? An almost 600% increase. It's like, whoa, what's going on there, right? We don't know. We don't know if it's wrong, if it's bad, if it was a decision that was made after the budget was prepared, and was being used. Was it a conscious decision to hire, consultant for 50 grand that, again, was made after, or is it some sort of an error? Maybe purchases that we meant to put into purchases got into consulting fees. Whatever it is, you're going to want to look into that and make sure you understand it, right? So that you can decide, is it here's where that course correction, are we on the right path? Did we expect to, obviously we didn't expect to have it or it'd be in the budget, but are we comfortable with it? And we're willing to have, have it as is, or is there a concern there? Right. And who knows, could lead to all sorts of things. Maybe that's a new project we're doing and the expense is fine. Maybe we expect to have a big bulge in revenue as a result of that as well, right? Because we're doing something special. Well, then maybe we want to adjust our budgets, right? And do that. Could just be how we're counting for things as well. So you don't know. But it's worth looking into to understand that. Another very meaningful report here that we like to use a fair bit is sort of a hybrid combination of your actual and your budget. So this takes your 12-month activity. So this is a company with a June year end, right? And they've had 5 months of actual so far: July, August, September, October, November. But this report tells us where we think we're going to be at the end of the year based on the 5 months actual and the remaining 7 months budget. Right? So in this case, we're not really concerned because we've got a great operating profit. But if you were a company that had some real cyclical times in your business cycle, and you maybe didn't have the good first 5 months that you were hoping for, and that you tend to lose money for 3 or 4 months, and then it becomes cyclical again, right? So oil patch is a great example, right? They have breakup. They have breakup in the spring and they have breakup in the fall. All right. If breakup went really long and they didn't, they didn't get the revenue that they thought they would in the first couple months after that, maybe they're going to be suffering in the summer. Maybe they need to look at increasing their line of credit, or at least be aware that they're going to be going into their line of credit, so it's not a surprise. Right? Those kinds of things really help the business owner complete their strategic decision making, or make new strategic decisions, or just sleep better at night, right? Knowing that, okay, I know I'm off the path, but I'm okay because I have this in place, I have that in place, right? It eliminates any surprises at year end and allows you to take action mid-year, right? So if you weren't looking at this, you might be just, okay, let's just stick to our guns, let's keep doing what we're doing. And then come the end of the year, you might be quite a bit off of your targets. Whereas if you look at this 4 or 5 months into the year, now you can adjust and maybe we can get back on target. So yeah, so that's what this report's about. Forecasting is a tool like budgeting, but it's not exactly the same, right? Forecasting tends to be a longer time frame. If you've ever obtained some bank financing for a large purchase or just in general, the loan tends to go over 3, 4, or 5 years. They will often ask for a forecast to sort of see what do you think your cash flow and projections and that kind of thing are going to be like over the lifespan of that loan, right? Because maybe you're fine for 1 year, but maybe you're finishing up some major contracts and your forecast for year 2, year 3 aren't nearly as good. So this is often for that. And it allows you to continue to make those strategic decisions, because lots of decisions we make are going to be for much longer than 1 or 2 years, right? So the forecast allows you to map that out and go, okay, I know I'm investing in this. I know I won't get much of a return from it in year 1. I know there's a big cash outlay for it, but in year 2, I expect my revenues to go up or my costs to go down, or, you know, that kind of a thing. I'm investing in for some infrastructure and my labor is going to go down. Those kinds of things then allow you to map that out to go, okay, well, when's my payback on that? You know, it's like, okay, great. I should, based on my assumptions, based on my activity, I should get, you know, I should break even by the end of 30 months on that decision. Okay, great. Let's make it. And forecasting also allows you to do different scenario planning, right? It's like, okay, this is most likely, in my mind, this is most likely to happen. But I'm going to do a forecast that's pessimistic, and I'm going to do a forecast that's maybe optimistic. But especially for me, I think and a lot of people, it's like the pessimistic one helps a lot because, you know, it allows you to, again, to sleep at night and go, okay, I think my revenue is going to drop or jump by 100,000 a month. So this is worth the investment. But you know what? Even if it only goes up 50,000 a month, which is almost guaranteed, I'll still be able to cover my loan. I'll still be able to pay my payroll. I'll still be able, right? Like those kinds of things, so that the person can go, okay, I might not make all the profit that I thought I was going to make. That means, you know, I won't be able to maybe do some of the other things I'd like, but I know that the business will still survive. So it allows you to make those kinds of things. The other thing that's nice about forecasts is that you can run, like I say, those different scenarios, and you can plunk them in at various times that you like. And the programs that we use are quite flexible. And so going back to our cafe, they're planning to implement some new changes in the new year. They're planning to hire an additional barista, purchase some new equipment, and implement a new advertising campaign. Using what we know about the past, because that's our base, and then the effect on the revenue that these decisions should have, we can project into the future and see the effect on revenue and cash flow that these decisions will have, right? So, you know, they're thinking about an Instagram campaign in February of 22. They're, the other things aren't necessarily on this screen, but the program allows us to put them in, move them around. We can even drag and drop, right? And say, well, let's start that 2 months sooner. Let's start that 3 months later, and adjust the projection on the fly, which is great. When we've done that, we can then start focusing on kind of what the lifeblood of the business is. We'll often hear that called that, which is cash flow, right? You know, profit and loss is great. And, you know, we certainly strive to make a profit, but even profitable companies can struggle with cash flow, right? If you're making a lot of money, but it's tied up in inventory or it's tied up in receivables, you don't have the cash flow, things can feel super tight, right? And so knowing what's coming in and out of your bank account is key, right? Your budget or forecast will place the revenue in the month when invoices are issued and expenses in the month when items or services are billed to you, which is great. That's good accounting, and that's you know, technically what you're supposed to do. But a cash flow report is going to place those amounts in the month when the cash actually comes in, or the money actually comes in, or the money actually leaves your account, which can be, you know, depending on the type of business you are, can be a really important, valuable exercise. Because like I say, I've seen companies where they had great growth And all of a sudden, they were paying for the wages, they were paying for the inventory, they were floating the receivable. And all of a sudden, 2 months into that, they're like, whoa, we've run out of cash. Now we're having a hard time meeting payroll because we had to pay all the people to do all this work, but our customers aren't paying us timely enough for us to be able to pay our people. We need a line of credit because we're growing so fast. Right? So monitoring that cash flow in addition to monitoring your budgets, your month-to-month expenses, your P&L, is also going to be able to give you good information. Okay, because sometimes you're able to, sorry, just one other thing on that, Samantha. Sometimes you're able to adjust your payment schedule, for example, right? Like you decide when you're going to pay your payables. So you can manage those cash outflows, right? You can decide to pay that person 15 days later than you were going to. You can put some pressure onto a customer to pay you 10 days sooner. You can offer them incentives. Hey, I'll give you a 2% discount if you pay that by the end of the month. Those kinds of things. If you know you need it, and you're more on top of that, then you can, make those decisions and spend your time doing that rather than spending your time doing something that doesn't provide as much value to the business. This is another report that we get out of a program called Fathom. And Fathom is a great tool that we connect with QBO for those clients that are on QBO. We upload information and it gives us, different reporting. This one is quite nice for those that like something a little more visual, right? Because we look at the financial information and lots of numbers, and maybe it doesn't, mean as much. It doesn't jump out at us as much. So this is a fairly simple representation of your cash flow, right? Green is good, cash coming in. Red is not as good, cash going out, right? And then it shows you. So, $417,000 of revenue coming in, $122,000 of costs, 118 of general expenses, gives some other income of 37. You can see that if you drew a line at that point, you're up about $220,000 in cash, right? Then there was taxes paid of 106. So now we're probably down closer to like 100, 120. Right? Other various expenses, changes in payables, changes in other liabilities, gives us our operating cash flow of 70 grand. Right? So, just like I said, different way to look at it. I'm not saying that this is the best or, whatever, but I do find when I work with clients that different clients see different things and resonate differently with different reporting. All right. So again, that same, I haven't used that analogy yet, but I do like the analogy of the, elephant, a whole bunch of people blindfolded. In that case, it's blindfolded, but, blindfolded touching the elephant. And it's like, so what is this? Right. And somebody says, well, it's a tree. I feel the tree trunk. And so, no, it's a rope. I feel, they're touching the tail. No, it's a kite as they touch the ear. And the same is true of looking at things, is that, different people will look at it from different angles and see something differently. So that, you might look at this report and go, oh, aha, I finally see, my revenue, my cost of sales, my overheads. I only get about a quarter of every dollar of revenue that helps contribute to the business. Right? They might not see that same thing if they're looking at the financial P&L, right? We're just numbers, whereas this is a little bit different. And we can do all sorts of things within in Fathom, where we can provide some of those line graphs that you saw earlier, some pie charts, bar graphs, things like that, that allow a better understanding of the financial information that you have. Okay. And then with this one, this is again just showing us a little bit more in terms of the cash on hand at the very bottom there. These different decisions that you've got. So web designer, digital strategist, office fit out, LinkedIn campaign, Instagram campaign. These are all things that we're thinking about doing. And we can adjust these, move them, and then it automatically changes and shows us what our cash on hand is going to be as a result of those. Now, there's a lot happening in the background, so we're not seeing the specific numbers on here or anything like that. I just wanted to show this to you so that you could represent and see it, that, you know, there's so much in the way of tools available these days that it helps you to do that. We can also record, and this is where I was touching on earlier, different scenarios, right? So we start with our cash on hand. So that brings us up to the end of November of 21 in this case, as far as dates go. Then we've got our forecast, which is the blue dotted line, our best case, which is the purple dotted line, and our worst case, which is the green dotted line. Right? So it allows us to go, okay, great. I know where I'm at. In this example, probably not a big concern because they're talking about cash on hand of, you know, $1.5 million to over 2 million. If that 1.5 million was, you know, or maybe the 2 million, if the 2 million is where we're at zero, not 2 million, you know, now we know we're in the overdraft. Well, this becomes a lot more important because we're managing the actual bank financing, the overdraft, the interest expenses, things like that. So it just helps in terms of different scenario planning. We're kind of on the last section. I just wanted to illustrate that once you have all of this good information that you're making decisions on, hopefully a better understanding of what's going on, that small changes can make a big difference in your bottom line, depending on what it is that's changing. Grabbing your historical financial information and loading it into another program that we have called the Power of One allows us to play around with that. And so on this next screen, you can see that we did a 1% decrease in cost of sales and also a 1-day improvement. So we reduced our payables by 1 day, so or increased our payables by 1 day because that helped us with our cash flow. We did this on the coffee shop. This is the information that they were doing. And we can see that their cost of sales, and cost of sales is a big, you know, big number for them, right? Because they're buying lots of coffee and product and stuff like that, improve their cash flow by $56,000 and increase their profit in the year of almost 50,000, 46,945. That's just a simple 1% increase or decrease. I mean, you know, maybe being able to go to their suppliers, find a different supplier. You know, it's like, no, sure, we know as business owners that that's a good thing to do. But knowing that that's going to save you $50,000 a year is a lot more incentive to spend the time to do something like that, right? And operationally, that's going to help. And a simple thing like deciding to, you know, drag our payables out by 1 extra day increased cash flow by 12 grand, right? So if, for example, they're in a crunch and they need 50 grand 1 month because they had one of those months where revenue was down and things were bad, basically they could come back and say, well, geez, a 4 or 5 day delay in my payables payments will give me the 50 grand that I need. Right. And that's pretty much about it. I mean, at the end of the day, you know, starts with good information, starts with timely information. Once you do that, you start developing the package of financial information that makes sense for you, frequency of when you review it, and that's going to start help you make you know, better decisions.